Hi, I'm Jim Jubak, and welcome to my YouTube video for December 15th. I just want to show everybody I got a new Mud Hens t-shirt. If you like this video, please like it. Please subscribe to my YouTube channel so that you get notification of when I'm doing the next ones. If you want to see more of my stuff, you can go to my free site, that's jubakpicks.com. So 6 portfolios instead of 3 on my paid site, that's jubakam.com, again, link down below. And we're currently in the last couple days of running a sweepstakes, giving away 3 free year-long subscriptions to the paid site. It's a $199 value, and it's free to enter, free to participate, free to win. And link to that is also down below. Today is actually Fed Day. The Fed's Open Market Committee met and released its prognostications. The consensus of Fed members is we could have as many as 9 interest rate hikes by the end of 2024, which leads me to the title of today's talk: why the Fed is bluffing on interest rates. I think 9 interest rate hikes by the end of 2024 is ludicrous. I don't think there's any way it's going to happen. Here's why. Here's why the Fed is bluffing. Here's why I don't think it's going to happen. The bluff is because inflation rates are running out of control. So we're talking about a 6.8% annualized rate in November. You understand why the Fed wants to convince everybody they're going to get on top of this. There are a lot of doubts on Wall Street, basically saying, hey, the Fed has waited too long. The Fed is behind the 8 ball, behind the curve on inflation. So basically what you're getting is the central bank saying, hey, no, we're not. We're going to be really, really tough on this. And I think that is an incredible bluff, an important bluff. They got to do it, but it's a bluff. The other part of that, the reason I think it's a bluff, is we've got numbers today on retail sales for November. This is the month-to-month increase in retail sales was a startlingly low 0.3%. The economy is simply not strong enough to support 9 interest rate increases by the end of 2024. The Fed knows this. We've still got, we've got another variant of the coronavirus on the loose. We've got big problems with the labor market in terms of getting people to work and productivity and all that. I don't think that we're looking at the kind of robust economic growth that's going to let the Fed sail through until the end of 2024, just leisurely raising interest rates as it goes. No, we're going to reach some point in here where the Fed says, hey, wait a minute, we got to pause. Inflation has come down, as we told you it would. Remember back before we said 9 interest rate increases, we were talking about inflation being transitory? Well, it turned out we were right the first time. So I think what we're seeing here is the Fed responding to those high inflation rates, responding to fears and saying, hey, we're not going to see those embedded in market expectations. This is a chart for the iShares 20-year Treasury bond ETF. Now you remember what happens to bond prices. As interest rates go higher, bond prices go lower. And here what we've got is this is a fairly long duration bond ETF, 20 years instead of 10, which is what most people track. So it's even more sensitive to expectations about long-term rates than the 10-year bond is. So what we're looking at here is early December, when the price for this ETF was way up at 154, and it's pretty much been down since then. It rallied slightly as people said, well, maybe the Fed won't raise interest rates as much as we expected. And now today we're seeing prices for the ETF fall. And remember, as I said, bond prices fall as expectations for interest rates go up. So what we're seeing here is a pretty good example of the Fed getting exactly what it wants. It's convincing people that, hey, what we said today, that we're going to look for 9 interest rate hikes, and we're going to cut the pace. We're going to increase the pace at which we cut our bond purchases. We were reducing it at 15 billion a month. Now we're going to reduce it 30. So instead of ending in June or July, we're going to end our stimulus there in March. So all of that is intended as a shot across the bow to convince financial markets that, hey, inflation is not going to become embedded. Don't start to expect it. The bond market is starting to react to that, at least by this chart, reacts to that. What I'd like to draw your attention to is not so much what happened today as what things are going to look like in January, February, March. All of the predictions are that the current variant is going to peak in January. the history of these expectations is that, well, things get worse for longer than we expected. But anyway, so you're looking at a question of what the economy is going to look like in January, February, March. Is the Fed then going to be saying, hey, you know, we're going to provide a little stimulus. We don't have to actually do anything. We're going to delay the interest rate increases that we promised you. That would have a stimulatory effect on the economy, on financial markets, without ever actually having to do anything. And I think that's what the Fed set up today with what I think is a huge bluff on interest rates. This is Jim Jubak. Thanks for watching. Check out my YouTube channel by subscribing. Give me a thumbs up if you like this, and please go to my free site, jubakpicks.com, for 3 portfolios, stock picks, my paid site, jubakam.com, with 6 portfolios, and hey, play in the sweepstakes and win a free subscription to my paid site.